As far as Europe is concerned, I think you're going to continue seeing a fair amount of volatility. I don't, even if there is a near-term solution to Greece, it's a near-term solution. We still really need to figure out how Greece exits this sort of deflationary environment that it is facing. Where do they get growth from? How do they harmonize the different countries in that region? So the challenges are many in the euro area. So we would say from a global perspective, in terms of allocation, you're still better off being towards the US and you're just doing global allocations. But obviously, if you're a European-centric investor, you should have European exposure. But otherwise, the appeal for being in Europe is less limited. We typically have a long-term view. It's at least 12 to 24 months in terms of average things that we look at in our portfolios. So I would say when I look at India, it's a structural story. So despite what might be happening right now in terms of some earning disappointments, some sectoral disappointments, I really see India as a structural story. We are overweight India in our Asian portfolios. In the pure equity portfolios in Asia, we are even more overweight India. And I would say that that's something that we're going to keep and ride it out over, I would say, the next 2 year or 3 year time frame. China, on the other hand, I think is cheap, but one needs to be still cautious about how and where this is coming from. There is a bit of a value trap in China. So I wouldn't ask people to be too underweighted China, but at the same time, there isn't possibly a need to be overweight China. And that's exactly how we are positioned.